You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it is time once again for Options Playbook Radio, a.k.a. what the cool kids call OPR. My name is Mark Longo from the Options Insider Radio Network. Going to spend some time today taking you into the world of some offensive plays you can use maybe to improve your returns, generate some income, some defensive plays. Maybe you want to protect said gains, or maybe you're on to some other roads and you have some questions, some queries. We'll help you out with all of that. Of course, it's not just me. If you're saying to yourself, hey, he's not usually on this show, you're right. You know who usually is on this show is the host of the show, Mr. Bryan Overby, the senior options analyst, a.k.a. the options guy over there at Ally Invest. Bryan, welcome back to your own show. You know, I'm always wondering, because we're the options insiders here, so that's enough of a burden. But you are the options guy. You're it. You're the guy. So you're the guy. Anybody has a question to comment, they have to go to you throughout the entire marketplace. That's quite a burden you put on yourself.
Well, it is, and I'm not even a cool kid because I don't actually call it OPR, which I thought that was kind of fun. I need to start because I want to be in the cool kid.
Got to be in the cool kid club.
Yeah, so on OPR, that's exactly what we're looking to do is just learn about all the different strategies that are available. And as always, we never really have an opinion on the markets. We're just actually talking about pricing and opportunities in the pricing realm to use strategies that are in the playbook. And with that said, I always love to get some listener questions, which means it's time for us to huddle up.
The Huddle. It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions at theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right. Those epic crashes can mean only one thing. It is time to huddle up on the old playbook. That's where you guys ask questions. Bryan, it's been a while. You and I have both been busy traveling hither and yon, doing all sorts of other fun stuff. So the mailbag is kind of piled up. So you got like 2 or 3 hours to sit here answering some questions. We got quite a few.
Yeah, I wish, because I do enjoy the questions. This is probably my favorite thing to do on Options Playbook Radio is to do our little huddle-ups and try to answer as many as we can.
Or do you mean OPR, as the cool kids call it?
OPR, there you go. I got to work that in.
It's going to infect you. You watch. You will. Okay, let's just go from the top. Let's see how many we can get to. Some of these are epic treatises, so we'll see. All right, let's start off with a nice, easy, quick one from the creatively named B-Stard. He says, hi. Well, hello, B-Stard. He says, I listened to the link to the show, he means, and I was unsure how you calculated a 37-cent credit from the front spread. It would have cost you $1 on buying the 205 calls, as this was the ask price, And if the bid price was 95 cents, a credit would have been 32 cents. All the numbers here, based on the ask price of on $1 on the 205 call. So I first came in, we had to do a little digging. So what he was referring to, he actually was referring to episode 260 of Options Playbook Radio. Came out about a month ago. It was the Apple covered call on steroids episode, Bryan. So I did take a chance. I had a quick gander at the old OPR episode right before showtime, so I could kind of familiarize myself with what he's talking about. And on that episode, if you recall, you talk about a way to not just do your old boring covered call, but to jack it up a little bit, jazz it up a little bit, add in that front spread, aka that ratio spread, listeners, to that. So you were talking about doing a 1x2. This was a June, expiring on the 14th, so expired about a month ago. The June 205, 207 half, 1x2 call spread. At the time, you said, I think the bid for the calls was like 95 at $1, so you'd buy that call for $1 and then sell 2 of the June 207 halves for at 66 cents, which if you work it out, yes, it does work out to what he was talking about, that 32-cent credit. So you're paying $1, selling $1.32 worth of options. You're collecting 32 cents. But Bryan, I think it's probably worth noting, when you're doing these, it's kind of after hours, and you're kind of, these numbers are kind of fluid. Would you concur?
The markets are a little bit wide, and because of that, and I always try to say this, you try to throw as many disclaimers in as possible, the midpoint would have effectively been around 37 cents. And one of the biggest things about doing it after the close is that the markets kind of widen a little bit after the close. They're not quite as tight as when the market is open. So after the close, a lot of times the markets will widen up a little bit. And because of that, when we talk about Options Playbook, we really focus on the midpoint. Now, a midpoint is a really good fill if you receive it. That means that you're right at the middle between the bid and the ask. So in this instance, if you did this trade and you entered it at market and the market was open, in theory, you would have received a 32-cent credit. I just was working off the middle of that, which was a 37-cent credit. And my guess would have been that the best case scenario on the credit would have been another 5 cents higher, basically implying that the 37 cents would be the midpoint and the net credit would have been a 42-cent net credit. So yes, there is a little bit of VIG in all of these quotes, mainly because we're doing them after markets. So I'd always, add a few cents onto that if you'd like, but we just need a starting point. And sometimes I'm actually kind of surprised, Mark, that this is the first time I've actually been called out on it, in that I'm not really working off a PowerPoint. I'm just doing these things, what they're unscripted. So the fact that you're going to think that you're going to always say the correct number is above and beyond. So if this is the first time we've actually had somebody have to jump in and actually correct that number or correct the thinking, in theory, yeah, why not? Why not? I like that. I like that people are listening.
Yeah, it's great that people are paying that much attention. Hey, write in with your questions. I think it's worth noting he was mentioning hitting the bid on he doesn't mention how wide the spread is, so obviously you're going to assume you get a little bit better, which is why he's talking about getting that midpoint, getting a little bit better credit. If you just hit the bid, lift the offer, 32 cents. He was hoping for a little bit more in there, hence a little bit higher. That's the dream, right? We can all dream. Better credits for all. That's our mantra.
And Apple actually got called away on that high strike on that one, looking at that position over that trade. So interesting trade nonetheless.
And yeah, you're right. If you had the stock, if you were comfortable letting it go, remember that was against stock listeners. It wasn't just the options; it was done against stock. Otherwise, so you were covered. Otherwise, you weren't covered. But still, fascinating one. We love you guys. Pay this level of attention. You guys are the best. Let's see what else we got. Now we're getting in some of the epic ones, sir. Buckle in here. Strap in. We've got. I'm going to butcher his name. Divinestri Treat, if it's Italian, a Tridacetrity would probably be the proper pronunciation. If it's not, I apologize. He writes here, it is really hard for the beginning trader to recognize what is a good source of information in the jungle out there. There was something different about Options Insider Radio, and I'm glad I have stuck with you guys and decided to learn about options trading from you. I listened to all of your podcasts, but Options Playbook is my favorite. Look at that love, Bryan. See the love from overseas, from everywhere, from hither and yon. He says, I'm a numbers guy, and my man Bryan talks numbers. There you go. See? He's feeling the love already. All right, he wants to know about SPX flies here. He says, I've been paper trading a strategy where I buy 5-point butterflies on SPX with 2 to 3 weeks until expiration. I usually buy 10 of them with my short strikes 10 points away. So he says, to give an example here, 28 quarter, 28.30, 28.35. And then I was convinced that my strategy was working for me, and I wanted to start doing it for real money, but I couldn't get a fill at midpoint. I goes back to the midpoint again. That's the sticking point for everyone. I tried to increase my offer from $10 to $15, and even $20. Waited a couple of hours, still no fill. I ended up putting in as 2 vertical spreads for a $25 debit. Now that is a big difference when you consider that I want to put 10 butterflies on. It goes from 100 to 250. So I end up with only 1 fly. Anything I could do to get better fills. I was trying to close the same position because my options were in the money, and I was afraid to be assigned and have to pay assignment fees. The way I understand my broker's fees, it's a lot more expensive to get assigned than to close positions and pay commissions. Yeah, usually there's added fees, and you have to get assigned. Because you have a stock leg and everything. There's more going on when you're getting assigned than when you just close it out. That's just a standard commission. When you get assigned, there's a lot more to it. Again, I couldn't get a fill. I ended up losing $720 trying to close one leg at a time. The bid and ask spread got really wide because there was no liquidity. Oh, well, lesson learned. Anyway, my question is, what happens when index options expire in the money? Well, that's a long way around to get to that one. Okay. He says, by the way, P.S. English is not my first language. I hope you got the idea. Well, your English was fine. Certainly, I used to be fluent in Italian. I'm assuming you're Italian. I used to be fluent in Italian. It's probably much better than I could write in Italian these days. So by all means, well done there. Diva Nestri. Let's go backwards, Brian. There's a lot here. He starts with index options expiring in the money. Obviously, it depends where you're looking. SPX is cash settled. You're talking about cash settlement, so wherever the difference is, you're getting some sort of cash debit or credit. And then he mentions, having issues with fills and also going from paper trade to SPX. I don't know, Brian, maybe you'd agree with this. Maybe it might be better for him to start something a little bit smaller, a little bit easier to manage, like a SPY rather than an SPX. Would you be maybe more willing for him to go that route if he's just starting out?
I'm going to say yes, because I also don't, we don't know who he's trading through. If he's using a foreign brokerage firm to execute, or if he does have an account in the U.S., because, overall, in the SPX, this sounds like above and beyond any trials and tribulations I've ever had trying to get fills in the SPX. So, yeah, I think that's a solid suggestion on your part to look at the SPYs. Now, obviously, you're going to, instead of buying one SPX, you would be buying 10 SPYs to keep it relative. But the liquidity is there, and I'm not quite sure why he's having so many problems on this. Here's one of the things. When the market's moving fast, the SPYs are a better thing to be in. When the market's moving slow, I kind of like the SPX in that I like the fact that it's a cash-settled index, which he's already asked that question on, and that it just, when it's all said and done, your account, you don't have to deal with stock, whatever profit or loss you may have, it just all shows up as it's cash in your account on the expiration date. So that's your answer to that question. But, yeah, I'm kind of surprised to hear that he's had so many problems with it, so I'd kind of like to know where he's trading. And then, second of all, the SPY, SPY, is probably a better solution if you're just going to be doing the butterflies outright. And the one thing that's kind of nice about it is it allows you to also leg out of your trade. In other words, not necessarily leg out of each position, but if I have a 10 lot on instead of a 1 lot, I could sell 5 of them. So there's some benefits in that aspect, but then the downside is usually that means more commissions, because a lot of brokers charge on a per contract basis. So there's good and bad with each of them.
Yeah, it would be nice to know where he's executing from, not to throw shade on any other broker, but just to know, because some brokers, especially international ones, are better than others when it comes to options execution and liquidity. So there could be an issue there with them getting your because SPX weeklies are pretty liquid. If you're going, like he mentions, doing these just in the weeklies, not too crazy far out of the money or too far out in time. That is kind of surprising to me that he would have so many problems with that. Obviously, there's benefits to doing SPX versus SPY, size being one, tax treatment being another. So you're going to lose some of that if you go to SPY versus SPX. But I think if you're just starting out too, you probably want to start a little smaller and grow from there. Make sure, and again, we don't know, you kind of mentioned the midpoint, but people have different ideas of midpoints and what that is. So some people have maybe unrealistic expectations of where they should be getting filled. So there could be some of that here as well. I'm not saying you are. I'm just saying in general, you haven't been trading very long. So it takes a while to get some experience in what the fills should be like in a product versus what you're seeing on your screen. So there's a lot at work here. You have a very multi-leg strategy, very wide, very large moving index, a lot of different moving parts, the broker, all these other things. But in general, I think you're doing the right thing. You're learning, you're scaling up. I think if you try SPY, if you try to keep them tight, keep them small, just see how that goes. Maybe be a little more conservative with your estimates of where you think you can get filled, and then try from there, as opposed to, you're right, working these things, piecemeal, a couple of legs here, a couple of legs there. That's more commissions. It's a pain. You're going to miss some of it, as you already have, it seems. So yeah, let's try that way, and let's know, see how that works. And maybe let us know who you're trading through, just so we can maybe give you some ideas of how you can improve that experience there as well. Because we want everyone at the end of the day. We want, what did we say before at the top of the show? More credits for everyone, right, Brody? Right, Brian?
Right.
More credits for everyone. I like it. All right, we got more treatises here, so stay buckled in there, Brian. Don't go anywhere. Next up, this is Joe. I believe I believe he's written in before. I believe he's from the infamous Joe and Linda duo. Where's the love from Linda? We got to get Linda on here, but I believe this is Joe from Joe and Linda fame. He's writing Bryan. Oh, he spells it shall we say the archaic spelling with a Y. I kind of like that, Bryan. Have you thought about switching it? Bryan? What do you think?
Nope, not at all.
Okay, no love. No love for the archaic spelling of Bryan. We'll just keep on rolling then. There you go, Joe. No love for that. He says, I was very grateful for your help with my last couple of questions. I'm hoping I could lean on you for a little bit more. First of all, I can't thank you or Mark Longo enough for the content you provide on the Options Insider Radio Network. Well, you are welcome, Joe and Linda. We give our regards to both of you. I haven't actually listened to much else for quite a while now. Well, we do that. We keep you busy. We promise nothing else. We will keep you busy with options content on this network. Because I either listen to new shows or rewind to listen to something over again. My question is regarding a strategy I have been using with Amazon. The progression has been getting more complex from just a plain straddle to straddles with trailing stop limits, then on to credit spreads using the straddle as a reference. Okay. At current, I have an out-of-the-money put credit spread on with a couple of back spreads, one for calls, one for puts. I set a trailing stop limit to sell one of the long positions in each of the back spreads if the stock gaps, leaving me with a credit spread on the side that is going against me. If the underlying heads the other direction, I reestablish a second long position from the one that was sold and tighten the trailing stop on the back spread, showing a profit. The position is usually a few weeks out, and most of the time that gives me enough time to adjust back and forth. Eventually, I do roll the back spreads further out and continue the same pattern. Am I approaching this correctly? I've had some success with it, but it seems like I am chasing my tail at times. I also run an Iron Condor and SPX. Everyone's got SPX going on today. I run an Iron Condor and SPX pretty regularly, basic weekly, and that seems more consistent. Should I just stick with the simple strategy for Amazon as well? Amazon has historical and implied volatility that's a little higher, about 10 points, than SPX, so the Condor would be a little wider as well. He has more questions. Condor is in the SPX. Let's get these other ones first, and then maybe we'll see if we have time to do this last part with condors. Let's start, Bryan, maybe let's start on the general theme, because we see this a lot. People put on these multi-leg spreads. He's talking front spreads and back spreads. So these are effectively ratios. We were talking about the front spread before, listeners, where in that case, we were going to buy one and sell two. The back spread kind of going the other way, sell one, buy two. So you like a nice little pop. Usually in your underlying, kind of which direction you're going. If you're doing calls, the upside puts to the downside and so forth. But Bryan, things get a little dicey when you start taking things off piecemeal on ratios and things like that. So maybe let's start there. What do you think about doing that? Start taking half of your back spread off. So now you got just the basic kind of credit or debit spread on. What do you think of that in general before we get into his approach to doing it? And then maybe we'll add on the addendum of, would you prefer he go for the old Iron Condor instead, which is a little more maybe risk mitigated, profit mitigated. You kind of know easier going in and out what you're doing there versus some of these ratios.
Okay, so I'm going to start by telling you exactly what happened the first time I read through this question before we were prepping before the show was too much. I just heard it. I just felt it. It was just like, this is just too much. In that I don't mind adjusting, and I like that you would have a plan. This is what I'm going to do when I put on this trade. Now, you're doing it in Amazon, which Amazon is known to have gap openings. Now, not necessarily around just earnings in general, But if you're doing these type of trades, this is where gap openings can kill you. So I'd rather almost just switch around things if I had to, and I'd rather do this type of strategy in the SPX and maybe do iron condors in Amazon. Now, that's not a recommendation overall. I'm just saying that in general, when you start doing all of these adjustments in an underlying like Amazon, which can be so volatile over time, it's hard to keep up with it. If I've done stuff with back spreads, and specifically, a form of a back spread, but you buy another leg of it in general, would be actually more of a front spread, but is a butterfly. And I like to trade a butterfly and flip it into a credit spread. But guess what? Then I'm done. I'm going to make one adjustment, or else commissions are going to start eating me up, and it's just not advantageous to keep going. In other words, I don't want the cheese anymore. Just let me out of the trap type scenario. I really think that one adjustment is enough over the life of the trade. Now, obviously, if you're doing a one-year trade, that might be a little bit different. But in general, from what I'm seeing here, you've kind of answered your own question in that, you're feeling kind of heavy, kind of burdened by all the adjustments that you have to make. So I'd lean towards the iron condor in the SPX. And if I'm thinking about that back spread, I'd maybe end up doing that in the SPX and do them both in that underlying and do something different in Amazon and just not let it get that crazy. We talked about a trade last week in Amazon just around earnings, and actually in that one we did a skip strike butterfly. So I feel what you're doing, and I kind of get it. But, I usually will do one adjustment on that advanced of a trade, and then if I'm wrong and a whiplash, let me say that again. And then if I'm wrong and a whiplash is against me, I just get prepared to get out and just close the trade and then move on to the next week's trade. That's basically my opinion on how I would approach it. I just think it's too much. Once again, that's the moral of the story is too much here.
It is a lot. And this happens a lot. People, they start trading. And we like people who are excited about trading and want to do more. And you guys are out there doing more. We appreciate, of course, you listen to all of our shows, including OPR, as the cool kids call it. But you're right. There's a lot going on here. I didn't even get to the last part here where he mentions hedging his iron condors with further out of the money positions to increase the deltas. I like the thought process of switching. You don't mention if you have an underlying component. That's kind of what Bryan was talking about in the first example there. We're using that front spread kind of against the underlying for the covered call kicker, I guess you can call it. But here, there's just a lot going on here, which I think switching to the iron condor may help. If you want, if the iron condor is not getting you excited enough, you want a little more action, you can go the fly route that Bryan mentioned, or indeed the iron fly. I've often joked on this many times on the network. The iron condor is the iron fly for cowards, right? So that will get you a lot. You'll be right in there. So you'll be paying attention. You'll be glued to your screen. So if the iron condor it just isn't sexy enough for you, and you want to do something like that, but I would prefer you go somewhere in those routes because those are kind of I'm not going to say set them and forget them because we like adjustments, but maybe not this many, but we like to watch them, and you can certainly take things off. But in general, something that has some more of a risk-mitigated profile, at the outset, basically where your max profit, max loss are going to be, and you can kind of play somewhere in that range. If you get into the ratios, you start taking things off, all bets are off. That's the same thing with the iron condor. If you start taking off legs randomly and leaving other ones on, that's a different beast, and you've created something different. So I think Bryan's on the right track. A little bit easier, a little bit simpler. You probably make your life a lot easier too. And then you could start maybe ratcheting things up slowly once you start seeing, the basic, simple approach. Well, I'd be curious what you think about the old iron fly. It sounds like just reading this, maybe you'd be a guy who might like that. All right, let's wrap it up, Bryan, on maybe a shorter, but maybe deceptively simple question, because this one could actually probably fill several hours. This comes from Ali. Ali wants to know, what's the best time zone to buy protection on a stock? So I'm a big fan of the central time zone, Bryan. It's here where Chicago is. That usually works the best for me. I think you're more of a fan of Eastern, right?
Well, that's where I live. I like Central. I miss Central time zone, though. I do. I got to admit, I just think of sports in general. I mean, the game. Heck, you want to watch a game? It's not over until 1:00 at night.
Yes.
If you're watching some football or some basketball.
Television watching in particular, Central is much better. But of course, I'm joking. I do believe Ali is referring to how far out maybe he is talking about American time zones. I doubt it. How far out to go and to buy a put on a stock. Bryan, like I said, this is a deceptively simple question because it actually isn't. It actually is a little bit more complicated. But maybe just in general, a rule of thumb. People like to go out. You asked 8 different people who are options professionals this question. They'll probably have 8 different answers. Some like to go crazy hard, have the gamma, get out there in the weeklies. Some like to go several. I was talking to someone this weekend who loves only playing in the leaps. He won't even think about anything less than a year. Some people like that 3 to 6 month window when they're buying premium, maybe, somewhere around 6 month and then rolling it to 3 or somewhere in that time frame. But it kind of depends on everybody. So I'm curious, Bryan, where do you fall when you're looking at your go-to protection strategy for a time frame?
Well, there's no golden book of answers for this question, but here's where I would lean. I would lean towards shorter more than longer. Because here's one of the things. If you're buying protection on the stock and you think you need to buy a 6-month put, you should probably just think about selling it, honestly. So if you think about going out that far in time, you're really more bearish on the stock than you'd like to think you are. A protective put on a stock that you own is really a bullish trade. Your best case scenario is if the underlying goes up. So if I'm going out 6 months in time and I'm correct on my forecast that the underlying stock is continuing on up, well, the problem is it gets so far out of the money that 6-month put is now really not giving me any protection. So I have to roll it up or do something to help adjust so that it's protecting my position again. So for that reason alone, I would rather look at the 1 to 3 month time period. And once again, that depends. If I'm looking at protection on a less volatile stock, I might go out 3 months. But if I'm talking about protection on an extremely volatile stock, and I'm not going to name any names, I'm probably just going to go out a month because volatility is going to affect the way that I approach that protective put. So, in general, the moral to my story, which I've said already once on this program, is in general, the moral to my story here is that I would rather err on the fact that I bought too little time than bought too much time. So if I bought a 1-month put and I was still nervous, well, maybe then I'd buy another one. But I don't like the fact on protected puts that I would have to adjust my strike price after I put it on.
That's why I like this question. Everyone has their kind of unique flavor for this. And of course, they pay for those puts in different ways. They'll do put spreads, they'll do collars, they'll do all sorts of fun stuff, which again is another rabbit hole we won't go down on this show. But yeah, there's all sorts of fascinating data. You talk to the folks at OIC and others, they like that 6-month time frame because that seems to maximize the time versus decay. Others say, like Bryan in the 1 to 3 because it's closer and it's cheaper. Others say 3 to 6. Others say leaps, nothing but leaps. So it's a fun conversation to have. Try it at your next dinner party. Ask around the table, how far out do you like to hedge your portfolios? And then look at the nice blank stares that come back at you. It should be fun. But Bryan, when you're not pestering people at dinner parties about their options timeframes, if people want to ask you more questions, and we still got a ton here, where should they go? What should they do, sir?
Well, as always, you can email them directly to me. You don't have to always send them to Mark. You can send them my direction. My email is theoptionsguy@invest.allied.com. That's the quickest way to get directly into my inbox. And I want to say, Mark, thank you for hosting, and thanks everyone for listening. Always loved a chance to huddle up and answer all these questions, and we'll be back at the same time, same place next week. So until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA, and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.